Hello, good morning, and welcome everyone to the CACEIS webinar series. So we are delighted to welcome you to our annual Securities Finance Overview, where we will detail the market figures, also a snapshot of the current regulatory progress, and about the CACEIS solutions. So the agenda is the following. So we are happy to have with us Matt Chessum, who is a director at S&P Global Market Intelligence. So Matt will review the figures on year-to-date and where we stand in terms of revenues for our clients. For the second chapter, I will present what's the current situation about regulation and hot topics impacting the securities financing activities. And we will have a quick focus on the T+1. And then my colleague Joanna will detail the CACEIS market solutions offer services in terms of securities financing and repo. So Matt, I will leave you the floor now for the market figures.
Thanks, Remy. So hello everybody, good morning. My name is Matt Chessum. I'm here representing S&P Global Market Intelligence. So at S&P Global, we offer a number of different solutions to the securities finance market. One of them is an independent proprietary database that provides daily transparency into the securities lending world. So the main source of the data for this product is collected from prime brokers, custodians, asset managers, and hedge funds. And the data is used primarily by the market to assist in pricing securities finance transactions, to help in identifying intraday liquidity, to benchmark portfolios, and to try and identify potential short squeeze risks as well. So let's go on to the first slide, please, Remy. So when we look at market revenues for the first 5 months of the year, you can see that the revenues generated by the securities lending activity during the period of January to May 2025 have been relatively strong when compared with those that were generated during the same period of 2024. There's actually been an increase of about 7%, and you can see that by comparing the two time periods at the end of this graph there. Most of the growth has come from stronger borrowing demand for both exchange traded funds, Asian equities, and government bonds. So given the heightened levels of volatility that we've seen across financial markets during the first half of the year, exchange traded funds have seen very strong borrower demand as they've been increasingly used for either hedging or thematic trading opportunities. Heightened activity has also been seen in leveraged single stock crypto-related ETFs as well. Now, this heightened volatility has also created lots of opportunities across Asian markets, as President Trump's trade tariffs have led to an increase in shorting activity across Asian semiconductor and microchip companies. Taiwan, Japan, Hong Kong, and Malaysia are all markets that have experienced quite strong increases in revenues as a result. Now, across the fixed income markets, both corporate bonds and government bonds have performed well when compared with the same period during 2024. Volatility that's been seen in longer dated bond yields and further moves in interest rates have really continued to create numerous opportunities for lenders of these asset classes. So when we look at utilization, we can see that this fell across the equities when compared with 2024. Now, this is a clear result of the drop in volumes that you can see in the 2025 bar chart, particularly across US equities. It has risen across fixed income assets, however, and that's grown from 14.8% to just over 17%. So if we move on to revenues by lender type, we can see that asset managers, pension funds, insurance companies, and sovereign wealth funds are all the most common participants within the securities lending market. Now, using revenues for the first 5 months of the year, we can see that asset managers have generated the largest share of market revenues. To the end of May, asset managers generated about 1.3 billion in revenues, and that's approximately 8% less than during the same period of 2024. And this difference is primarily due due to the fall in the high number of high-value lending opportunities that those sort of portfolios have seen when compared to the previous year. Pension funds, however, did experience a 3% increase in revenues, and insurance funds were pretty much flat on what they experienced during last year. Now, the other section covered by this graph, which includes corporates and retail investors, experienced a large increase in revenues of about 43% during the period when compared with 2024. This sector included a notable increase in retail participation in the securities lending market, which has boosted revenues. So the basis point return fell across equities over the year as asset valuations continue to rise. Returns seen across fixed income assets remained the same or increased. However, as borrower demand for the asset class continued to grow. What we've been seeing is that very short-dated and long-dated government bonds have been responsible for most of the increase in returns, as concerns around increased debt issuance and the future path of inflation and its impact upon the future path of interest rates has really boosted borrower demand. So if we move on to global lendable balances, so we can see that following the record highs seen across global equity markets during the first half of the year, it's going to come as absolutely no surprise that lendable values have increased when compared with last year. Lendable inventory increased across pretty much all market participants, with asset managers now contributing about $24.5 trillion worth of lendable assets to the securities lending market. Now, the size of the lending market also reached its highest level ever last month, and that was just over $43 trillion worth of lendable assets. So moving on once again to on-loan balances. So average on-loan balances have increased across all market participants during the period. And that's pretty much a result of the significant increases seen in market valuations. Now, the largest rises took place across pension funds as fixed income borrowing activity really did increase over the year. Pension fund balances increased by about $116 billion. Sovereign wealth fund balances increased by $83 billion, and asset manager balances increased by $79 billion during the period. Now, across the entire market, average on-loan balances increased by about 14%. So, securities lending revenues really have had a boost during the first half of 2025, given the injection of volatility, the increased levels of geopolitical risk, and the growing concerns surrounding the issuance of government debt. All asset classes have pretty much experienced sustained borrowing demand as numerous trading opportunities have continually presented themselves to borrowers as a result of the ever-changing and swift-changing news flow. As we saw at the beginning of the presentation, the first half of 2025 has actually generated the third highest first half year of revenues since our data service started in 2006. Heading into the second half of the year, we believe that activity is going to remain elevated. Geopolitical risk is going to continue to grow, producing increased demand for hedging and directional activity. And we really believe that Asian equities are going to remain in demand. And whilst the strength seen across ETFs may subdue slightly, we do think that they're going to remain popular amongst borrowers. So I hope that gives you a bit of a flavour as to what's been happening in the first 5 months of the year, Remy. Back over to you.
Thank you, Matt. Thank you very much for these very interesting figures. Very interesting. So let's go to the second part. We will move to the chapter of regulation and hot topics impacting the industry in 2025 and the year after. Let's move to the hot topics to start. So we have some different topics impacting the securities and the lending industry. So first of all, and one of the most important, is the regulation. So plenty of topics in terms of regulations, a very large panel of regulations. What is keeping everyone busy at the moment in terms of discussion, but not only, also in terms of work groups. This is the T+1, which is expected to enter into force on October 27. So the T+1 is a topic that has been very well anticipated in the US, and it is on track to be as well very well anticipated on the European market. The complexity for the European market is the combination for T+1 with the CSDR penalties. Because even if there are some penalties on the US market, they are not big, very, very small, not significant at all. Even if CSDR is considered to be a bit low for market participant in order to make more efficiency in terms of settlement, there are some reflection to increase the CSDR by maybe 15 compared to the current penalties. So where it could be tough is that if CSDR penalties are increasing in the same time than T+1, that could maybe have an impact for the market participant. But it looks like there could be some more delay on CSDR. In terms of reporting, so SFTR is on track. And now going forward, expected for 26, that's the 10C1 reporting for the US market. The 10C1 reporting is a bit more complex because that requires to have several reporting intraday. At the moment, it looks like it will be 3 different reportings per day. So that's an increase of volumes in terms of reporting that would require some innovation. We will see the innovation later, but that will require an investment from the participant. Now, one of very important topic in terms of impact for the banks is the following to the Basel III, it's Basel IV, with the main topic is the RWA consumptions for the banks. So there is what we used to call the output floor. Meaning that in terms of RWA consumptions, there are some different models that are used by the banks. So proprietary models or standard models. The proprietary models are less restrictive than the standard models. So the purpose is to find in the middle. So an equation that would not leave to the bank the capacity to have some proprietary models as large as they would expect, but to be not so far from the standard models. So that's a regulation that is still maybe impacting the profit split, for example, for the funds, because lending on behalf of beneficial owners to borrowers can have an impact for RWA of the banks. So there could have a selection or some classification of the lenders. That's what we used to call the smart bucking. But the good point is that Basel IV has finally integrated the diversification of the collateral, which looks very, I mean, obviously, this is very standard, but it was not before. So that's a very good point to consider that depending on the collateral that is posted, the RWA consumption should not be the same. In terms of regulation on the North America, so there is still the mandatory clearing on the US Treasuries, but sorry, following to the President Trump is looking to put some deregulation on the US banks. That's a very important topic because if it happens, that means that for the US bank, it will be much easier to put some business and to increase the business with less capital immobilization that are required for the European banks and also and moreover for French banks that are really much constraints compared to that. So that's not treating banks equally if they are North America or European, and that could give a significant advantage to the US banks. And now to finish on the dysregulation part, the ESG. So ESG is on track. That's now standard practice for securities lending. That means that we had some webinar in the past on that, saying that the securities lending complies with the ESG policies. Now that's a very standard practice in terms of blocking securities for proxy voting, exclusion of collateral, and selection of the providers. Once we've said that on regulation, we can go to the geopolitics. So as everyone knows, the Middle East crisis, the current crisis in the Middle East is still unfortunately today. But contrary to what happened in Ukraine, for example, it has very few impact on the markets. The most important impact that may have, and that happened on Q1 this year, was the tariffs that required by President Trump on the US that made some volatility on the US market, and the pause that was decided by President Trump for 90 days will end on July next week. So at this stage, no one knows if President Trump will again implement some reciprocals, but that may have some volatility impact. In terms of monetary policy, so no rate cut anticipated for ECB in Europe. We consider that that will remain stable. That's the consensus. But another consensus is that the US rates should be cutted before N25, maybe September or a bit later, October. The real question is how much? 25 bips, 50 bips? At this stage, different opinion from the participant, but definitely the Fed will cut the rates before 25. The impact on the long-term bonds is for the sovereign countries, so sovereign issuers, sorry. That means that what will be the issue for the sovereign issuer to refinance the debt? That will be an additional cost for them, but we can be confident that the countries will manage that correctly as it was in the past. No trouble is expected on the top countries considering their liabilities. But the main topic that remains for this part is the cost of the cash. The cash still remain expensive. That means that to refinance some securities, we are still at some decent levels, but also the impact is on the cash collateral. So our clients are very often asking if for securities lending, we could do some cash collateral. And it's important to understand that when you accept or you require cash collateral, that's a cost for the collateral provider. And that means that the benefit that you will make to reinvest the cash is something that you have already paid on the loan because you have lent lower than the market. Considering those topics, one more topic, which is innovation, which is an important topic. First one is the follow the sun, that we're coming from a market where we were under batches. Now we go to real time and to comply with the obligations. And the T+1 is a very good example because we will see later, but in order to be able to go to the T+1, that's important that there is a treatment of the operations permanently from the trade date until the settlement date. Also the repo clearing, so that's the clearing of the operation of repo is important because that's a benefit for both buy side and sell side. For buy side, because buy side can reduce the RWA consumptions, but also that means that reducing the RWA will be the opportunity to provide some more aggressive levers to the buy side. So the buy side will be able to trade at much competitive levels. And finally, so it's been announced this week. We are very proud to announce that CACEIS is the first French bank that has received the approval from the regulators to trade on cryptocurrencies, meaning trading currencies, but also that's a way in order to for us to transfer and to deliver the currencies. What happens then in terms of lending revenues at the end? So the revenues are above 24. They will remain below 23, but 23 has been a very good year historically. But now, in order to be on track with that, we consider that 25 will be between 22 and 23. On year to date, there is a lack of special on the US market. The US market is the largest market in terms of securities lending. And when the US market goes well, the market is doing well. But if the US market is below, the total of revenues of the industry are lower. This is what Matt explained on his first slide. But the good news is the growth drivers coming from the ETFs and the Asian market. So the ETFs have increased very much in terms of securities lending revenues, and also the Asian market, following to some volatility since year to date on those markets, have generated some significant revenues. And finally, which is very important to mention, that there is still some demand for term trades for collateral downgrade, meaning sovereign bonds versus equities, to improve the liquidity ratios for the bank. So the demand remains pretty high. Now we've seen the hot topics. We can move to focus on the T+1. Even if it went really well on the US market, it was very well prepared. There was no earthquake on the US. The European market is more splitted on different markets. As you may have seen, the European T+1 committee has published some high-level roadmaps for the transition to T+1. That's 60 page and 21 recommendations. So there are some a lot of work group on that. The purpose is to anticipate as much as possible the transfer to T+1, and in that context, the securities lending, the challenge for securities lending is to be able to recall and to return the securities to the lenders in due time in order to avoid some delay on settlement. And thanks to that, the CACEIS securities lending program is very much secured to provide to the clients the benefit of a very high level automations. The second main topic is the borrowing. So that means that offering to the clients the capacity to borrow to improve the settlement efficiency and to avoid the CSDR penalties, because the shortest cycle for settlement would require from the participant to get more liquidity from the lending market in order to improve the settlements. And again, but Joanna will detail much more later in this webinar. CACEIS is able to provide some very interesting offer to the clients. And finally, in the T+1, the financing. The financing was the challenge for the funds, for example. As of today, on the subscription redemptions, the standard practice is T+2. So there will be a gap with the cash market, which will go to T+1. So what's going to happen if you have subscription redemption T+2 and cash market T+1? So you will need some financing, certainly. On the US, the 40 Act funds, which is the equivalent to the UCITS funds in the Europe, were already able to do some T0 before the T+1 in the US. This is not the case for the UCITS funds. That means that some financing solutions could be offered temporary or not to the clients in order to face the gap between these two cycles. So lot of things to say. Very strong, very important and very large topics to discuss. I will now leave the floor to my colleague Joanna to present the CACEIS Securities Finance Solutions.
Thank you very much, Remy. So I'm very excited to follow on the positive news from Matt and Remy, that volumes on the market are increasing, that revenues on the market are increasing. So I hope that you join us today to learn together what kind of solutions we can offer if you still don't trade with CACEIS. And if you already do, I hope that I can trigger your interest in potentially some other solutions we can offer. But first, I would like to start with introduction of our team. So securities financing team of CACEIS is not standalone organization. We are part of a broader market solution product line. which has above 300 employees working together. So we service different client needs. So we provide foreign exchange solutions, such as direct effects, automatic effects, but also hedging in portfolio hedging or share class hedging area. We also offer execution to our clients in different kind of assets, equities, ETFs, fixed income. And of course, on the back of it, we ensure that everything is automated and operationally efficient for the client, giving them the space to focus on their core activity. We also support middle office and back office for our clients. So we ensure that their regulatory reporting needs are addressed. We help them with collateral management and with hedging. Securities Finance Solution is also part of this broader group. So we work together with our colleagues from our trading rooms, from our dealing desks, in order to help all together to find our clients, the best solutions for our clients. But why CACEIS? So looking at our group, what makes us a strong and valuable counterparty? Because we are part of Crédit Agricole group, and we enjoy a strong credit rating, which we can share with our clients. When you do your risk assessments, it's good to have your trading with a strong counterparty such as CACEIS. But on top of it, we offer additional benefits. First of all, being a custodian, we have a very strong risk culture, very strong commitment to our clients. We don't don't engage in proprietary business activity, and we focus on automation of our activities. So we really want to ensure that front to back, all the services are provided to the client seamlessly, but the clients can again benefit from front to back solutions. And another benefit is CACEIS has experience with a very broad customer base. We work with clients from different jurisdictions and different type of legal equity entities. We work with asset managers, with pension funds, insurance companies, central banks, and all this helps our clients because we know the regulations, we know the compliance requirements, and we continue to build our solutions to tailor them to meet all these requirements of our clients. So saying all that, I would like to go further to the securities finance product. Key points about CACEIS. CACEIS has securities lending program for over 20 years, and we keep growing, we keep increasing our lendable assets, our client base. Our dealing room is based in Luxembourg, but we have global presence because from many years we built a strong global network with our counterparties. As you can see, we're connected here across the globe with all main players on the market, and we have a strong reputation as their counterparty. Looking at the asset class we are servicing, we can trade equities, bonds, corporate convertible government bonds, ETFs, ADRs, GDRs. But any new asset class, if it could be lent, will be added, of course, because we are following industry developments. Maybe a couple of words about the markets. Currently, our clients investing in many different asset types and many different markets, and we follow to support them. But securities lending cannot be provided on every single market where you can trade. For example, some markets require specific due diligence. Some owners, asset owners in some jurisdictions cannot do lending because it's not approved by regulators. I can give you example of asset owners in Spain. We have some limitations on this. From such markets as India cannot engage in lending activities. So we are a member of Securities Lending Association, where we engage with regulators in order to open new markets, in order to develop business. And this year, securities lending was welcoming Saudi Arabia, which is a new market right now, and we are looking forward to open other markets like Philippines, Qatar, and others. So we will continue to follow this development, which means that we can increase revenue for our clients even further. And here we are looking at expertise of our team. Our senior team members have experience over 15 years in this industry. We work very closely with such industry experts as Matt from S&P Global, with Dataland, with other global industry players, so we keep up to date. We participate in many different work groups and workshops to really be up to speed on all the market developments. And we are supported by a very skilled middle office and back office team, and also we are engaging a lot with IT development teams. So client knowledge I already mentioned. So I think this is the focus of our program. And also we are focusing on performance. So for this, we use benchmarking tools to be up to date on the market, because securities lending is an OTC market. So we want to know that the levels we are trading are market comfort, but we do provide best execution to our clients. But in addition, we really strive to be efficient in execution when we're dealing with our counterparties. It means that we use quantitative tools, we use machine learning, and we continue to innovate. We even received an award for most innovative lender. Saying this, I will move further to the solutions which CASIS can offer. I would like to highlight that not every custodian can offer such a broad range of product and securities finance, and it is my pleasure to highlight what we can do. So we're looking at securities lending, borrowing, and securities financing, which Remy already mentioned. So in securities lending scope, the main purpose for our clients is to generate additional revenue from the assets we are not actively using. And here we have several ways to do it. One of them is agency program, when solution will be outsourced to CASIS, and CASIS would trade on behalf of our clients based on the counterparties approved by the client and based on your parameters and your criteria. The other way is to deal with CASIS as a counterparty in a principal model. Then you will face only CASIS. CASIS will be your collateral provider, and CASIS will again respect the rules and parameters as agreed with our clients. The last solution in securities lending is remote or third-party lending. It's the solution we offer for the clients which are not in our custody. We still can help them, especially if their custodian is not lending or if you want to diversify. And we are here as well to explain which solution will be the most suitable, principal or agency, cash, non-cash solution, and what we can offer. Looking at securities borrowing, it becomes increasingly important product, and we are seeing more and more demand from our clients for different purposes, but main purpose is to avoid fail coverage. And with increased pressure on CSDR and T+1, again, this becomes a very hot topic for us. Here we can offer two solutions, which are differently priced, so we are there as well to help you to design the right one. So fail coverage means when the client needs to cover their securities failure in order to avoid CSDR, avoid buy-in. We are there to help on demand, and we can offer our global pool of assets, so which we service many different asset classes and regions. So we have a strong supply, but in addition, we can also reach out to the market and find securities which we don't hold in our pool. So we can borrow in and then redeliver to our clients. Another solution is auto-borrowing program, which is even more simple and more efficient. It means that as soon as our custody system detects short position on our client account, it will trigger automatic request for borrowing, and further the borrowing will be done by our dealing and executed further by our back office, by our middle office and back office. So these solutions are available for our clients, and they can also be used in parallel. Lending and borrowing can be done by the same client depending on the needs. Now we are looking at securities financing. So again, the liquidity management becomes more and more important topic. We are hearing a lot of requirements, for example, in the pension funds area with the new regulation, for example, in the Netherlands, seeing increased demand. And here we can offer different routes. One of them is asset switch, which can help to optimize your collateral. So we can, for example, trade French government bonds versus equity or any other asset class. We can help with repo solution. CASIS has a broad experience of offering repo services to different type of clients, pension funds, insurance companies, central banks, and we can do both repo and reverse repo, acting as a principal counterparty of our clients. And the next one is liquidity management. This is even more tailored solution, which we can discuss with our clients if we, for example, have fund units or any other assets. So to sum up, we are here to help you, and please reach out to us if you would like us to design specific solution for your needs. And we can speak together with Remy, with our very experienced trading desk, to offer you what you need. Thank you very much. And I pass now.
Thank you, Joanna. Thank you very much. So now that's the time to go with your questions. So I can see already some questions in the chat. Do we expect that deregulation trend in the US will slow down the implementation of Basel IV or possible longer delay Basel IV to be adopted across Europe and US banks? That's a very good question. I can give my thought on that, but what I think is that the US market will it's not decided yet, and that the regulation will be applied. But for sure, to me, what is going to happen is that the Basel IV will continue, will progress for the European market. It will be complicated to adopt one single regulation across Europe and US. I'm not sure it's going to happen, but we will. I think that at least during the Trump president mandate, we will remain with some. We may remain with some discrepancies between the obligation of the banks on both sides. Can you elaborate on lending challenge regarding recalling? How often happens? So for the T+1, I understand. That means that T+1 has been very well anticipated on the US. So we have seen no disruption on how lending activity for our clients, and we've been able from day one to settle our clients on the US market who were selling their securities. On the European market, we've been starting working on that already a few months ago, and we consider that considering the innovation that we are bringing to our systems, the improvement to facilitate and to make the chain the shortest as possible with our clients, we will be able to replicate the same performance that we have done on the US market. It's important to consider that the securities lending market is matching automatically the cash market. So for T+1 market, securities lending is on T+1 or shorter, and for T+2, securities lending is for T+2. So we believe that it will be the same for European, and we are working on that to be ready for day one. Can we please have contact? For sure, we will share our contact with you. I'm checking out. So we are just on time. Thank you very much for participating at this webinar. Thank you very much, Matt, for attending this year again.
Thanks, guys.
We are really delighted now to have Joanna in our summer webinar, if I can call it like that. And we look forward to hearing from you following to this presentation. And if you have any question, please feel free to send them to our desk, and we will be happy to answer. Thank you again.